Global market uncertainty pushing markets lower to kick off September's trading. And joining us to talk about the markets right now, Mandy Xu, chief equity derivative strategist at Credit Suisse. Also, Mike Santoli, who is CNBC senior markets commentator. And Mike, let me ask you, why do you think the futures are up this morning? Is this because of Hong Kong? Is this a bounce back from yesterday? What's it play?
I think it's both of those things, and it also reflects the fact that we've really just been bouncing around in this range. If you look at yesterday's action, actually, never really got a lot of downside momentum, especially even after the 10 a.m. release of the ISM number, which was weaker than expected, but probably not weaker than a lot of people were braced for. I think it was pretty telling that you still got bond yields making a slight new low, and the stock market didn't get a lot of headway on the downside. So to me, the market's not really kind of showing its hand right here.
Right,
You've been in this range for about a month. Sentiment has gotten very, very negative. Everyone knows September is typically, or at least on balance, pretty negative. And so I think that's what's being fought out. You have on one side the kind of we're in a recession countdown camp. On the other side, you say, look, cost of debt has gone down a lot. We actually have credit markets that are still in decent shape, and profits haven't fallen off a cliff. And the picture of that is a range-bound stock market.
Mandy, you don't think we're headed for a recession?
No, our house view is that we're not headed to a recession because of the resilient U.S. consumer. But the point that we make is that you don't need a recession to get a significant equity correction. In fact, the macro factor that's most correlated to the equity market is global industrial production. And we've seen weakness there. For example, in 2015, 2016, we had resilient U.S. data, but weak global manufacturing data. And what happened? We had extended periods of high volatility and equity market weakness here.
The one difference, Sam, is that this time around, you're looking at such low interest rates that it's hard to find other places to put your money at this point.
Yeah, but that only reinforces what I said before, which is that I think it's very hard to have a recession when interest rates are zero.
For anybody who missed the top of the show, you keep waiting for a recession, but every time you see signs, it turns out to be a head fake. It reverses.
The fact that I'm waiting for one is probably a positive sign because complacency is usually the major factor that leads to big surprises.
So, Mandy, you hear something like that. Could this time be different? Could this time, even if we're looking at weak global industrial production, could this be different, at least for the U.S. markets?
I mean, I would agree that there's not a ton of complacency in the market, which might sound surprising given the market's still near all-time highs. But at least in the option market, we are seeing a repricing higher of volatility. And more importantly, in terms of the flows that we're seeing, people are hedging, right? They're not chasing the upside as much as they were in previous periods of market sell-off. So I think, and if you look at, hedge fund positioning, they're actually cutting their net long exposure to multi-year lows as well. So I think from a range of factors, I would agree that we're not seeing the complacency in the market right now.
Mike, what are you watching?
I mean, you could have an unsatisfying economy and profits that are kind of hit or miss based on the sector and the company and not have a recession. And I think that's what the market's been trying to deal with. You got to have keep two separate thoughts in your mind at one time, which is at some point, yes, it'll probably technically dip into a recession. But we've had two of these periods this cycle where it seemed like we were almost there. In 2011-12, we thought it was a relapse of the prior recession. Then 2015-2016, you had an industrial recession. You had a profits recession, not an actual economy-wide one. And both those times you had the market go basically nowhere for more than a year and a half, and you released higher after that. And I think credit markets were a key part of that.
But isn't the real problem that pundits like you and me and her haven't been right?
About what?
About anything.
Well, I mean, is that new this cycle, though?
We sit here and we predict, and it's going to be this, and it's going to be that, and we're worried about this, and we're worried about that. And meanwhile, the game keeps going.
Sam, what are you doing in the meantime? Are you investing in anything? Are you hoarding cash, waiting for this recession to show up?
We've certainly never had a cash position like we have now. I think we're very reticent about, the opportunity. We think there's going to be some significant opportunities. But what we don't see is the urgency. What we don't see is the movement that's pushing it one way or the other. And I don't see any dramatic, in the Great Recession, the whole scenario was compounded by the fact that we had mark to market right in the middle of a recession. I mean, it was insane what was done. But that took a difficult situation and made it impossible. We don't have anything like that today. We have full employment, and we have an environment that's semi-positive, not wildly positive, but certainly not negative.
When you say you've never had a cash position like you have today, can you put that in context or put numbers on it or give us any sort of...
Well, I mean, a lot more.
a lot more because you're just waiting.
And and a lot, and anybody who's been in business for a long time knows that the vulnerability that occurs when things change rapidly translates into liquidity, and liquidity equals value. So consequently, you're sitting here saying, when is the liquidity going to disappear? I mean, we're already seeing changes. I mean, right now in the oil patch, despite the fact that there's unbelievable liquidity, there is no money in the oil patch. None. I mean, the deals that are being done right now are so much better than they were a year ago for the investor. It's not even comparable. So the answer is that there's fear, and particularly in the oil patch where they haven't used the capital very appropriately, they're basically withdrawing the money, even though everybody else has too much.